For the SA, and then for the S&P 500, it had decreased by 39.09 points, or 1.42% on Monday, and it had increased by 4.02 points, or 15% on Tuesday. And the top performers were Amazon and Nvidia. And then for NASDAQ, it had decreased by 137.75 points, or 1.84% on Monday. It had increased by 20.06 points, or 0.27% on Tuesday. And then, of course, the top performers for that was Amazon and Nvidia there. So one of the things that happened this week was between Amazon and Twitch Prime, they're giving away free games. So Amazon, they're offering 5 free games for every one of their Prime members, and they can download that, and then they can basically keep it in perpetuity. And so Twitch, so Twitch is actually owned by Amazon. This actually happened in 2014, where Amazon had purchased Twitch for, I think, $970 million. And so now when you have Amazon, you basically get a free Twitch membership. You have 2-day delivery, you get free PC games, and of course, with the Whole Foods acquisition, you also get the Whole Food service with this Amazon subscription. And so the question that I have is how can gaming companies like Gold and the PSN, which is the PlayStation Network, how can they match Amazon with their newfound strategy? And then to follow up, furthermore, what does this mean for Netflix and other streaming companies?
Feel free to call on people.
Dan? Ryan?
We're not hearing anything, guys, so turn on your mics.
I don't really know much about all the video game stuff, so like Gold and PSN, I don't really know how those work, and I know what Twitch is, but so I really have no viewpoint on it.
Okay.
I'm just about the subject.
Okay. What about Sean?
Yeah, I actually don't play video games as well, so I don't know if I have any knowledge on this.
Yeah, the thing about it is that, what I found like very interesting was it was a research I had saw. It was saying how Twitch, they have literally more subscribers than most cable television companies, and they're killing the game with more subscribers and like almost like catching up as far as like with like more than like Netflix, HBO, and other providers all combined together. And so I just found that was just really interesting, the fact that, they're just taking up so much competition, so much space from all the other companies. I just sort of feel like it's kind of hard to compete with a company, especially when you're offering free games to people every single month for free. And it's kind of like taking away from people who are on like the actual PlayStation Network and on those, and as far as like HBO, Netflix and stuff, it's just really difficult to actually have those people tuning into those places and stuff. So do you guys think that possibly with Netflix, what potentially could this do for Netflix and HBO and other companies? How do you think they could possibly respond to those, I guess, like the pressures that Amazon's now putting on those companies? Dan?
Are you talking about are you switching over to streaming now in terms?
Yeah. So like they're also, far as like we're streaming too, it's kind of like they're basically taking most of their, like far as like like most people, they're like far as like with the gaming stuff, like the users now have like they're more on Twitch than like far as like Netflix and HBO and like other cable companies. So it's kind of like they're taking them away from as far as like those companies. So it's kind of like it's really crazy how Amazon with Twitch now, it's just really difficult for taking their competitors away, or like taking their customers away from those people. So how does that kind of like affect more of like Netflix and like those companies?
I know. I think like Netflix has such a stronghold in the original content, so I feel like as much as companies like Prime and Hulu and whatnot try to steal that market share, it's going to be tough. In terms of Twitch taking away from it, I think it depends on user preference, like what you want to watch. I Is Twitch a separate membership than your normal Prime? Like, do you have to get Prime and then Twitch Prime?
No, so once you actually get, well, based off what I read, like once you actually get Amazon, you get Twitch for free
Yeah.
by having the Twitch Prime itself. You actually get that.
So I guess if you get both, then maybe it would hurt Netflix a little bit because people who want the Twitch, they'd already get Amazon streaming, so why pay for Netflix kind of thing. But
Yeah. Yeah. Okay.
Okay, don't move on so quickly. I really liked this discussion because a couple of things happened here. One, we talked about the gaming industry, and your question was, well, what do you all think about this? It doesn't matter if you know gaming industry. This is Amazon entering another market, and so everybody in that market starts to quake. And then Dan, I think your point was really a good one. Well, for Netflix, their counter to Amazon is all this original content. You're exactly right. That is something that Amazon doesn't have, but that Amazon is continuing to grow. So this was a really nice discussion of what is happening with Amazon and how they continue to push those tentacles out into new markets. You probably saw they're now the second largest company by market cap. They passed Google yesterday. This is a behemoth that's entering into all kinds of industries. They're taking their technology and allowing it to penetrate into a bunch of different industries. So really good example, Chaz. And Dan, nice add-in discussion.
Pro. I can't believe we're playing out Pro. What are we? Which team do you want? Wow, look at it. It's actually really coming down.
All right, so now heading to the next one, I was very disturbed by this one. So the SEC charges Theranos founder and CEO Elizabeth Holmes. She was charged with fraud. I think it was March 14th. She was charged with deceiving investors into believing that her portable blood test could produce the same results just with the prick of a finger. And as a penalty, she was required to pay $500,000, surrendering voting control, and she can't serve as an officer for at least 10 years. And the big question for me is, and this was the first thing that I saw, that it was the first thing that I wanted to know when I was reading the case, their auditors. And when I was doing the research, I had found that there was no auditors even present, and they didn't even have any audited financial statements at all. And so I was just in awe on how you can have $700 million given to you and nobody questioned your intentions on are these trials even true? Are you actually, is this stuff actually really working? So my question is why did investors not ask Theranos for audited financial statements? And if they did, could this have prevented her from reaching a net worth of $1 billion or over $1 billion? Sean?
I mean, maybe they didn't ask her for the audit financials just because the money it was bringing in for them. I don't know if it was kind of like a conflict of interest. And if they audited her, I mean, it potentially could have helped her from reaching the net worth because they would have seen kind of what she was doing was wrong with the company, I guess.
Mm-hmm. Yeah, I was looking at some stuff, and as far as how they filed, so they basically, when we were learning as far as in our SEC class, they had actually used the Form D. to file, to not really be under huge scrutiny. Under the SEC, where they can basically file as far as like they can get money from fundraising by accredited investors. So they can have like investors basically, whether they have like $200,000 in annual income, or they can have like an investor with $5 million in assets, or I think they can either have a net worth of $1 million, that they can basically get money from them and not necessarily have to literally just kind of like note to the SEC and say, okay, well, here's basically where we got our money from, our fundraising, that's basically it, without having to go through the huge scrutiny from the SEC on having audited financial statements. And because they were private at the time, they didn't necessarily need to have to do those things, which is kind of like the strategy that she basically took. And her lead guy, I think his name was Bawani. He was the guy that was basically kind of like, I think he was the president of everything. And he was the guy that kind of like was in charge of creating this binder where he had like clinical trials with the reports. He was the main guy even in charge of creating the financial performance reports. And I just found that it was just really disturbing, just the fact that nobody, and the thing about it was too, far as like with the Department of Defense, she even said that how these reports were like far as like, you know, like these lab tests were mainly used for people in the military, in the war. And it seemed like her charisma was like the biggest, like that was like her greatest strength. She knew how to talk to people. She knew how to influence people. And I guess she influenced them so much, which I think she's like the greatest con artist of all time, in my opinion. The fact that she can have she can grab $7 million, $700 million, and not one person asks one question as to saying, is this company actually doing what they're saying they're supposed to do? Like there was zero professional skepticism. I was just in awe at how they were able, how she was able to do that. Yeah, Angie?
While that may be true, like I totally understand where you're coming from, talking to people is definitely key, but also how did she know like what forms to use? How did she know, like with the SEC, for instance, like what threshold not to reach to not be under such scrutiny? Like you said, you know, $200,000 for donations. If you go above that, obviously that raises more question marks, you know, because it's more money coming in. So she obviously had to have help. I saw this in the news, but there was no sound on, so I didn't really listen and I didn't really read about this particular thing. But did she have help? Like was, you know, her internal maybe accounting office or internal audit? If there's no auditing here, obviously somebody who was doing the financials had to help you with.
Well, see, it wasn't the $200,000 in donations. It was just like, you know, like in order to be an accredited investor,
Mm-hmm.
you have to have an annual income of $200,000.
Okay.
Of doing that. So the fact of the matter is, you know, the fact that, you know, she didn't, by, you know, as far as like with that Form D, you don't necessarily have, like you can sort of skip around certain things rather than having to go through the full process.
Well, how did she, that's my question. How did she know what form to use? She had to have some help.
I'm pretty sure she definitely had people telling her, maybe you can go this route, do this way, and you can like skip. Because the thing about it was, they didn't have any audited financial statements. Because remember, SEC, you have to have 3 years of financial statements, as far as like with income statement stuff, 2 years balance sheet, all that stuff. But if she would have filed, she would have to do all those things. Well, when she was there, she didn't necessarily have all that stuff. So I think there was one statement where she had to say, you know, well, we weren't going to file until we got $10 million in revenue.
Gotcha.
And she had lied, I think in 2014, where she had told one investor saying, well, oh, we have $100 million in revenue, when she only really had 100,000. Like, that's crazy.
I like this. Now keep this in mind as you guys become rich and famous, because you're going to be asked to audit different types of statements that, or different types of firms that, you know, Arthur Anderson. You get too close to your client and you don't ask the right questions. And she was able to avoid having to deal with auditors. And as you think about investing, especially in startups, those churn rates are high. They go through a lot of money, and there's very little control over how they're choosing to spend their money. So keep that in mind, both from an investment standpoint with your own portfolios later on, and also from a client standpoint. Charisma can only get you so far. You have to follow those rules. And so expecting your clients to do so and being willing to push forward even when they're pushing back against you, that's ultimately going to be your jobs.
All right. So then the next one was Walmart goes national with the home with the home grocery delivery. They announced that by year end they'll have 800 stores that will be offering the same grocery store delivery service. They're projecting to have 100 They're projected to reach 100 metropolitan areas and 40% of households across the U.S. And their charge delivery fee would be $9.95 delivery fee, and it must be over $30. And so comparing this with Amazon, Walmart, and Target, because Target is also starting to get into this too. Amazon, they sort of have like their subscription service as far as like with it being, I think it's like if they have the home, if they have the grocery stuff, as far as like delivered to their customers, I think it's like $15 during like far as like with the subscription service if they use the full benefits. So if they do that throughout the year, that would total to $180 per the year. And of course, they have the Amazon Prime, so it's going to be free delivery. And of course, it's free delivery over a $50 minimum fee, over $50 spent as far as like with groceries. Of course, you see Walmart, there is no annual fee, but there is $9.95 per delivery, but you have to order $30. And then Target, they have the $49 for the first year, and then they have $99 for the second year, and everything continuing on. And you have to, you will get free delivery if you have $35 over the minimum. So my first question would be, do you think that Walmart and Target do they have a chance against Amazon in this sector?
So I think what's interesting here is that nobody really thinks of Target as having this grocery delivery. I never knew that they did that, and I don't think they're advertising that well enough. I think that Walmart's strategy to do per delivery is actually the wrong move, just because I feel like people are more willing to spend one large lump sum once a year rather than to see their grocery bill be $10 more every time they buy something. And I also think that here Amazon has the partnership with Whole Foods, which is really important to people, and you don't see where kind of Target is getting their groceries from. People associate Whole Foods with really fresh, healthy products, and Target, again, not so much. You think of it as more of that bargain retailer. So I think that Target has a better shot than Walmart here. I think that if Walmart really wanted to compete, they should do a one lump sum payment and then get rid of their per delivery, because I think people are not going to like that.
Okay.
Completely agree with you, Tyler. I think your point is a really good one. Really good. Yeah, if you pay it one time versus, if you've got a $40 grocery bill and every time it's 20% higher because of that $10 charge, you're going to be less likely to use it versus paying one time. And you might as well do it every day and have them send you groceries as often as you want.
And then question 2 would be, do you expect to see a huge decrease in store traffic for Walmart and Target, seeing that they're going to be opening up grocery store shopping as far as dealing with online, or no?
I kind of think no, because at least for me, I enjoy going to Target, and I kind of feel like people who go to Walmart, I associate with being like in the older crowd. So I would think a lot of people, at least like just thinking in my family, like my mom and my grandma, would still be more likely to go into Walmart and Target. I think Amazon really has like the online shopping sector.
Mhm. Yeah, I agree with that.
I also think that like Target's kind of like you go to Target having maybe one thing in mind and then you leave with a ton of different things. Like you have to walk around their store and see like what all their deals are. So that's more like an experience, and I don't feel like anybody specifically goes to Target just for groceries.
Mm.
So I think that they're more along the lines of like the cheaper like retailer and maybe like furniture, home goods. Walmart, very similar. Like you go for more like when you're first moving into your dorm room or something, whereas Amazon definitely has the delivery. I totally agree with Bridget on that one.
Yeah. And honestly, I don't like that, like just the idea of just people touching my groceries. I just don't like. I cannot see. I mean, I did Peapod one time, but when I had did it, I just hated it because I mean, there's certain things of how as far as like being a shopper, that you want certain things, as far as like whether it could be picking something all the way from the back or picking a certain kind of the way it looks, because everybody doesn't have that same care that you do. And honestly, I mean, I don't think that I would want people consistently picking out my food for me when I know there are certain things I might want a certain way. And just the fact that Amazon, no, not Amazon, but for like Walmart and Target, they're trying to do something like this and trying to compete with Amazon in that way. I mean, I agree that I don't really think that store traffic will significantly decrease in any way because of that. And also too, like what you said, Tyler and Bridget, that when you do go to Target, you see one thing, you want to pick out many different things because like, oh, I need to have that because so yeah, this is the shopper mentality.
I also think that the consumer that would be shopping at Walmart and Target for their groceries, like it's not like a Whole Foods or a Trader Joe's where you're like looking for a premium, more expensive product. You're going there because like Stop and Shop and whatnot, they give you really good deals on your groceries. So if you're looking to get cheaper prices, then I don't think you would do the online because you'd be having to pay a premium for that. And so it kind of it take away from the whole point of shopping from those stores. So it'd be just better off going in and not having to pay. I wouldn't want to have to pay that extra $10 every time or $100 a year.
Mm.
It's interesting. I think you guys have made some good points. You may have seen the ads on TV recently about Walmart. They've got some branded clothing. So Walmart is trying to move into the Target space. Like Tyler was talking about, you go in and you look for a lot of different things. You don't really think of Target as groceries. And I think that's true for most people as well. But they do have some clothing that's decent. They have some branded items. They've got different home goods with the fixer-upper lady and her husband. So they are targeting sort of an upscale Walmart, and Walmart's trying to compete with that right now. It was interesting. I was in Kansas City this weekend, and my daughter-in-law just had another baby. And so they've got a grocery store there called Hy-Vee. And what she ended up ordering her groceries. And Chaz, to your point, my thing with ordering groceries has always been, I like my bananas green. And I there's certain things that I'm going to want to pick out myself. With Hy-Vee, you're able to write a note on every single item. So on the banana, she said, I need them half green because I was in town and I was going to eat a banana. And so, and they delivered them that way. I was really pleasantly surprised by what she got. So these guys are also competing with grocery stores. Tyler, somebody made the point that Target really isn't advertising much about this. And I think Tyler's point's really an important one. You walk into Target to buy one thing and you leave with a basket full. So Target's got to be sort of ambivalent about this whole idea of delivering your groceries. that's a market, but what are they losing by you not coming into the store? So that's a bit of an issue that Amazon doesn't have to deal with. And now with Amazon, with Whole Foods, this is big. Now you can think about Amazon as good groceries as opposed to Walmart or Target that you might question the quality a little bit. Big space, big market, and big opportunity for these guys as they compete.
All right. So now we're heading to the Facebook data scandal. So Cambridge Analytica, a data analysis firm that consulted for the Trump campaign, had skirted Facebook's guidelines to gain access to 50 million profiles, misusing this data for targeted political ads. Cambridge Analytica, they had worked with the academic researchers to set up personality quizzes, the app, and 270,000 people gave permission to access their friends' profiles. I feel guilty of this because I did a few of them myself. I'm a victim. So Cambridge Analytica, they had used this data to actually build political campaigns. And in 2015, Facebook had learned that Cambridge Analytica, they had gathered this data. And they had sent a letter to Cambridge, and they had said that, that this data needed to be deleted, but Cambridge never did. And Facebook didn't follow up until the journalists actually found out that it still existed. And so in response, the past couple of days, Facebook stock had plummeted 7%, which is the worst day in 4 years. And so the question that I have is, do you think that this Facebook data scandal was more of a public relations issue than a fundamental problem? And then after that, follow-up question, and do you guys think that Facebook issues will spark broader regulation in the tech sector that will affect all the FANG stocks, which is, of course, Facebook, Amazon, Google, and let's see, I'm trying to think what's in Netflix. Yeah, what the N is.
Yeah, Netflix.
Yeah, Netflix. Yeah, it's Netflix. Okay, yeah, Netflix. Yeah.
I think it's both. I think that it's a fundamental issue because you can't have kind of these massive data breaches and then trying to cover it up, but it's also a public relations issue because people are going to react to this. You can see it, with the hashtag boycott NRA. Like, people are really trying to associate and invest in brands that they really believe in and that they think are doing right by them. So Facebook saying, oh, well, delete this data, and not informing anybody that all of these users had their data put into Cambridge Analytics for Trump campaign. I mean, that's not really great press for them. I'm sure that a lot of people are really upset about having their data used, but then why can't Facebook control like where their users' data is going? That's also not a good thing. As a tech giant, you should be able to do that.
Yeah, they're still trying to figure out the fact of the matter. Like, they're still trying to question Zuckerberg, I think, on certain things, and Zuckerberg is still not yet to say anything about, how they were able to have their data basically used for political gain for Trump. And there's still not any questions about it yet, but they're still trying to figure that out now. But yeah, I just feel that that definitely with the public relations issue, because I mean, for some reason, like, they're always like in the news for doing something that they shouldn't be doing. And as far as like what I was saying, like with the fundamental problem, that was more of like hitting at, will their earnings be really affected? Even though they did lose, I think it was like almost like $70 billion because of this, and their company's worth still way more, like hundreds and billions of dollars. In the long run, I don't really think that As far as like with that fundamental problem in itself, I don't really think that it will be that much of a huge effect on how their earnings really are as a more of a material type value within of that. And as far as like with the regulation stuff, I don't really see it being that big as far as like with regulation, because I mean, I just feel that, just with this one little incident, the fact, well, not little incident, but the fact that there shouldn't, like, I don't think there's going to be like heavy regulation on the tech industry because of this. I just think that it's just allowing more people to be aware that things like this, as far as like with security and having your privacy, someone being attacked, it is becoming more prevalent today, the fact that we are moving more in technology and allowing that people need to be more aware of when logging into different things, as far as like with the personality quiz. I probably did like 12 of those things. So all my information on like Dan and Tyler, all you guys got your stuff. they already know a lot about you guys because I've been basically tagging you guys and all that stuff. So I just kind of feel, just that the trust, far as like within Facebook, and having them do that, I just don't really feel the same anymore about it. So I might not even click anything ever again now. So who knows? I don't know.
Yeah, I think that as much as it's a Facebook problem too, I think just like you were saying, it will hopefully be an eye-opener to people about just how much data you have on yourself out there. Like even when logging into different apps and signing into different things, I normally try not to do it through my Facebook account and try not to ever allow permissions just because of how much information is out there. And so I think that people also need to be more vigilant about what they click on and actually understand what you're doing when you agree to let random apps or companies access all of your personal information.
Yeah.
I think it's a two-way street. I think Facebook's just getting a big hit because obviously they do need to police it a little more, but I don't think people are focusing enough on the fact that it's not just Facebook's fault. Like, people need to be aware that when you click I accept, you're letting go of all of your personal data. So
yeah. Angie, do you think it's a fundamental problem, or do you think it's more of a PR problem or a fundamental problem? Fundamental meaning, as I said before, their earnings being affected more than like their future earnings sort of basically being affected in the long run.
Well, personally, I think that we all found a scapegoat right now to just kind of be like, wow, our information is being used for something that we essentially didn't want it to use. But honestly, every single time that we we click those personality tests. Like, I'm guilty too. I mean, listen, I took tests like what kind of pizza I am, and I got even more hungrier. That's the thing. So, but honestly, it always says, like, you give permission to for them to access your information and everything. And granted, they may not like contact you or like run their ads on behalf of you, like on your profile, but they can still look at all of that. Like, we click okay and we go do it. So that's it's kind of like essentially on us. So it's not like we can tell like Facebook to conduct like a lot of other investigations as to where our information is going to go. So I totally agree with what the previous person said. We need to watch out, like whether we do something, through our Facebook profile. Because even, for instance, like I know like Grubhub, when you order food, you can log in, you can create a personal email, or you can log in through Facebook or certain things like that. So, they do have, essentially, Facebook does make it a lot easier, just like, oh, bam, I'm in, I just need to quickly do this, but all that data is available. And so personally, I think that we found a scapegoat. And Facebook, like, be like, okay, well, that's just my personal opinion. I think it's on us essentially, because we shouldn't just, give our data away like that. That's what social media does, and voluntarily we give it up. But now that we're realizing that, we're just blaming Facebook for it. But it is what it is.
Do you think it's more of a PR issue than a fundamental issue, Professor?
I tend to think it's a fundamental issue for Facebook. I think they have been careless with how they control the data. And I also, while I agree with Angie that we all have personal responsibility, I think in general, we expect companies to protect us. You know, you could say the same thing about drugs. So you have personal responsibility if you choose to take an opioid, but does the company have responsibility to not put out something that's addictive? And I think in this case, Facebook, to a certain extent, those pizza surveys are addictive. And so it's one thing for Facebook to have that data. It's then it becomes their responsibility to manage who gets it and how it's used. And the fact that it's been used to influence, potentially has been used to influence elections, that starts to get pretty dicey. And that it's being used, that Cambridge is using it to set people up in some inappropriate ways, that has issues too. So I do think this is going to fundamentally affect Facebook's earnings, because they're going to have to put all kinds of new controls in place. So they're going to spend a lot of money on this. Both Sandberg and Zuckerberg are getting highly criticized for all of their activities unrelated to Facebook. Sandberg is out pushing her Lean In book, and Zuckerberg did this world tour. So they're getting criticized for not focusing on the core business. What I hope doesn't happen, and what often does, is we then go in and over-regulate and then gradually start reducing. And I think about socks. I think Sarbanes-Oxley was a gross overreaction to what was occurring at the time. And I think that will probably happen here. The good news is it takes a while for legislators to figure out exactly how tech companies work. And so while they're trying to figure it out, hopefully the companies will put some things in place that will lessen some of that regulation. This is new, and this is a new area of our personal information getting out there. Until you guys started talking about it, I hadn't really started thinking about all of those personality surveys that I've clicked on, that I've responded to. It's like, oh, yeah, I guess there is a whole bunch of my information out there too. Hadn't really thought about it, but you're precisely right. So I think Facebook is at fault. I think all of the companies are at fault to a certain extent that are working in social media, and they have to figure out a way to improve their systems, and they're going to be forced to do so. Angie, what were you going to add?
I totally understand I agree with what you're saying, but I also think that nowadays, with social media, wouldn't that also be considered like market research in a way? Because for instance, say if, they do partner with any of these social media, networks, Instagram, Facebook, LinkedIn, and whatever, say a campaign or a company is looking for that. If they agree to buy that market research, to learn about their potential voters or about their clientele, I mean, I feel like now it's almost changing, because before, we'd buy market research for domestics, when you look out, should we build a big property in this area, a big storefront, and we buy the market research to see what kind of, people live there, whether they're rich, whether they're poor, whether they'll shop there, whether we build a Starbucks there. Well, now I feel like it's almost changing into the social media thing. That's how I see it. I mean, it's not exactly ethical, because a lot of it is done out of ignorance, because many people don't know, especially kind of the older generation. Sometimes they'll click on something and they completely, they don't realize that all of that is given. But I know from my parents personally, but at the same time, I think that times are changing, and the way market research is working for particular individuals.
I think you make a great point, Angie. I used to work in real estate finance, and I worked with the Shopping Center Institute, and they could tell you if they were going to place a Pizza Hut in this location, they could tell you every neighborhood around and what your buying trends were. So they had incredibly detailed information. If you live in this area, you tend to drive a blue such and such car, and they had really specific information about all the different all of the different neighborhoods and the socioeconomic and buying trends of those individuals. This is the same sort of thing. You're getting buying trend information on people. The difference here is that the information that Facebook is gathering that information, and then it's being used by others in ways that aren't necessarily what we had hoped. Mm-hmm. You could argue the same thing about the Shopping Center Institute. Could they tell you that a strip club would be really good here? So they could use that information in ways that you might not find favorable if you were in the neighborhood where they're about to put a strip club. Your point's valid. And when you were talking, I was also thinking about in the past in marketing, they would have subliminal messages. So there would be like behind the scenes in a commercial, there would be an almost a white noise kind of saying that said, "You're hungry, you're hungry, you're hungry," to get you to go buy food. So we have done some of this in the past. The fact that social media is able to do it bigger and better because of its reach, I think is why they're probably drawing so much criticism right now. And then tying this all into the election in Russia and all is getting Facebook hit harder. But the problem with Facebook right now is it doesn't feel like they have control over the data that they're collecting, that they are giving it out way too freely. And that's where I think people are very concerned.
Okay. And then the last one is that the European Union, what happened this morning, so the European Union passed, they are now proposing a digital tax. And so Europe, they want to raise billions of dollars in taxes from tech companies, such as Google and Facebook. So the European Commission, they're proposing two measures. Either one, they can have a 3% tax on revenue generated from digital activities, including online advertising and the sale of user data. And then the other one is they either have a preferred long-term solution, which is a tax on digital profits regardless of their physical presence. And this will only apply to companies who have a revenue, as far as with the first one, it will only apply to companies that have a revenue of $920 million. I think it's crazy to do this far as with that, because I was reading today that I think Facebook made about, I believe, $39.2 billion in advertising. And the fact that taxing that amount of money, I think it was saying that in almost a year, it can be like $6.1 billion every single year that they'll make off just taxing of digital taxes. And so many of the companies like Google and Apple and Facebook, and I think it's eBay, I believe, that they're trying really hard to fight this because I think they believe that the European Union, like the European countries, like they're trying to, take away their money. They just think they're just robbing them. And of course, the European Commission are saying, "Oh, we're not robbing you. This is just digital tax." And I'm just looking. I'm like, wow. I'm like just taking like a certain percentage, like just taking 3% of $920 million is just absurd amount of money of taxes. So I guess my question is what do you guys think of this proposed new this proposal that the European Commission is trying to do with digital taxes on these big companies? Do you guys think it's good, bad? Do you think it's fair? Do you think that the European countries are trying to take money away from these companies, from these American companies, just for their own potential gain? What do you think? I see you're smiling, Dan.
Well, I don't know. In my personal opinion, I feel like the EU is kind of launching a war on Silicon Valley. After all the antitrust stuff and now with this and everything that's going on between US tech and the EU, I think it's all just getting a bit crazy. And so far from what I've read about the proposal, it seems like a lot of EU companies won't have to pay this digital tax. And so I think it's a bit unfair towards the US companies. And I think that it kind of just shows that Europe is not scared, I guess, but the US's tech presence is so big that Europe is trying to build theirs, and it's just not possible. So they're just trying to target US companies in a bit of an unfair way. I think for the companies themselves, I don't think it'll be a huge. I don't think it'll have a huge impact on them. It'll definitely have some impact, but I think it's. I don't see it passing. I guess.
Yeah.
At least without some contention from the U.S. in response, because so far, as much as I've read about it, it seems a bit one-sided against U.S. tech. So.
Mm. Yeah, I think just because the fact that with this new, like far as like with this data breach, far as like within Facebook, and then like of course with the Cambridge Analytica, they were really trying to, like as you were saying, like I believe that's far as like in an unfair way, were they trying to get at them now and being more strict with them and trying to, it's kind of like it's like taking more of, I feel like in like a more of a personal approach, even though they're not coming out directly saying it. I still think it's somewhat it's uncovered right now, the fact that they're trying to do it indirectly, but they really want to say, what, like you guys, like, kind of like screwed up. So it's like, now we're trying to come at you. Now we want to want to start charging you guys on your presence, regardless of whether physical or not, or even if you're in that location, we still want to try to get something from you guys if we can. So I just think, as you were saying, I do think it is unfair, and I think that it will definitely be a huge fight, and they will, and they're definitely not going to go down without a fight between those companies and stuff. So, does anybody else have any opinions about that?
I do. The European Union on May 25th is launching the GDPR, which is the General Data Protection Regulation. And basically they're stopping all of the big data mining that these big companies are allowed to do in the Europe. So they pretty much won, in my mind. The European has done what they need to. They have forced all the big companies to make massive changes to their data privacy rules, and will definitely hinder their ability to data mine in the European Union. So,
Dean, I like when you weigh in on tech-related issues. Do you think this is a reaction to the tariffs that the U.S. is implementing in certain industries, that this is their way of creating a tariff-like situation for U.S. tech companies?
Not necessarily. I think it's been a long time coming. I think it started since Edward Snowden first released his report that the NSA was spying. And they weren't just spying on U.S. citizens. They did a lot of European data mining. That was the big thing that his report talked about. His report was mainly focused that they were doing a lot of European data mining on the citizens, and obviously the EU did not like that. And then after that, a law student named Max Schrems, I think he was a German law student, took Facebook, Yahoo, and Apple to court over the fact that he couldn't control where his data was going and then how they were using it. And then since then, there's been a long list of kind of like cyber attacks or cyber on data. And in 2015, the UK government said the biggest threat for its citizens was a cyber threat compared to any other physical attack.
Got it. Okay.
And that's it.
Nice job, Chaz. Anybody have anything else? You saw Uber this week with the pedestrian that was killed. There's still more to come out about that, but Uber was sort of repairing its reputation, and that occurred. It was interesting in Baltimore. There was an article in the Baltimore Business Journal that it was praising T Rowe on its early investments in a number of startups, but the headline was T Rowe invests in Facebook and Uber and other great startups, and it was trying to congratulate T Rowe, but it was at exactly the wrong time. The Facebook scandal came out, and then the Uber death happened. So it was an ill-timed headline, but in general, it was a positive article about how Facebook is able to, or how T Rowe is able to grow its returns for its shareholders because of these investments. So it was just bad timing. All right, anything else from the markets?
I saw an interesting headline with Google trying to help other retailers combat Amazon. They're trying, so like, I didn't like go in and read the story, but I saw a headline saying how like Google was trying to work with retailers to try to help going. I guess like trying to like ship far as like with the competition, because like Amazon's like literally just taking over everything, and so now Google's trying to find ways to help those retailers combat with the competition with Amazon.
Yeah. Yeah, it was. They're using Google Analytics for some of that, isn't
Yeah.
it? Yeah, using their data, much
Yeah.
like Facebook did. Be careful, Google. Go
Yeah.
forward cautiously, I would say. Okay. Okay. You know how to do everything in Chapter 8. There's a little bit of content around. There's a little bit of content around what bonds are, but in general, you know how to do everything. So what have we done? We're learning how to do capital budgeting, and where we started was in looking at. Let me skip that over. We started in looking at how we build a capital budgeting model, and now we're going to start looking at all the components of it. We figured out how to figure out cash flows, EBIT plus depreciation minus taxes. We figured out initial outlays and those cash flows that come at the end of the life of the project. Now we're going to figure out how you come up with that discount rate, and the discount rate is a conglomeration of your interest rate on your bonds and the interest rate on your equity, and then valuating those. So this chapter is all about how you figure out your cost of debt, and you absolutely know how to do every calculation. A typical bond costs $1,000 initially, and what you get is interest payment every 6 months typically, and at the end of the life you recover that $1,000. So the value of a bond is just the present value of all of those payments. And what we know is that when interest rates go up, the cost of the bond goes down. And that intuitively makes sense, because what's happened when you buy a bond is you lock in at a rate. So if your coupon rate is 6% and interest rates go up, and that means that if interest rates were at 6% when the rates went up, now people who own bonds are getting 7%. So you're getting $60 a year in interest payments. They're getting $70 in interest payments. For you to get somebody to buy your bond, you're going to have to lower the price of your bond. So when rates go up, you're locked in at a low rate. The value of your bond is going to go down. In reverse, if rates drop, the value of your bond goes up. So that becomes important later on. So here's an example we'll run through. We've got some government bonds that are expiring in December of 2020. We're assuming right now we're sitting here on January 1st, 2016. So this is 2 years ago. The rate is 6 3/8%. Unless you're told differently, the par value of a bond is always $1,000. Typically, I will always tell you, but typically bonds are semi-annual, so they pay interest twice a year. If the coupon rate is 6 3/8%, that means it's earning 6 3/8% per year, or half of that, $31.87 every 6 months. Okay, and the bonds were issued on January 1st of 2016. So here's what the cash payments look like. $31,875 every 6 months, and then in the last year you get your $1,000 back plus your last coupon of $31,875. And to value that, if we know that the yield is 5%, we can do the calculations. This is the formula. We don't really do formulas. Instead, if you were doing this in Excel, you're just finding the present value. And the numbers that you know is, there's 5 years left in the life of this bond, so your N is 10. This is 2 payments per year. Your interest rate was 5%, so every 6 months, that's 2.5%. You cut that in half. Your payments were the interest payments of $31,875, and your future value is $1,000. And so you compute your present value, and it turns out it's $1,060.17. And why does that not surprise us that it's above $1,000? So this is a premium bond. You're earning 6 3/8% coupon. The yield to maturity on similar bonds is 5%. So they're earning less in interest than you are, and therefore your bond is selling at a premium now. So it's one way to keep it straight in your mind if you've gotten the right answer. If you look at the yield and you look at the coupon, if the coupon is above the yield to maturity, the bond has got to be selling at a premium. And the reverse is also true. Now, what if the yield is 11%? Now how much will the bond be selling for? You should immediately know it's a discount bond. And in fact, it's selling for $825. And you could go through and switch your yield to maturity to 11%. The only thing you would have to change on your calculator or in the problem is switching the interest rate to 5.5%, or half of that 11%, to arrive at the yield. Now, if you were going on to take fixed income, you would use these formulas in Excel to do the pricing of the bonds, and I'll show you some of them as we go along. For our purposes, we really don't have to switch formulas. We can use the same present value and rate formulas we were using before, and I urge you to. The challenge you have here is if you put something in incorrectly. But if you're trying to find the price or the present value of the bond, you put in the date that the bond expires. In the earlier example, that would have been December 31st, 2020, and you have to put in the full date. I'm sorry, you put in the date that the bond was issued, and that would have been January 1st, 2016. The maturity date, December 31st, 2020. The rate was 5%, so it would be half of that is 2.5%. Your yield and your redemption, so how frequently is it being redeemed? So you can do the full bond formulas, but you don't need to. You can just as easily go through and use our present value and our rate formulas from before. Oh, okay, and now we're going to have a chance to do that. So I want you to take a look at problem 2 at the end of chapter 8, and I'm going to go ahead and put you into breakouts. So take a minute and go into your breakout room and do problem 2, and then come on back and we'll look at it. And I think you're actually going to calculate 3 different prices for bonds. And once you're done with the problem, if you would, come on back in and we will we'll check and see how you did. Let's see. We'll just put you in 4 rooms. So go ahead and take a couple of minutes. You should see breakouts. Good. You should be able to go into your breakouts now. Leah, did you guys have enough time in there? Oh, I can't hear you. Turn on your mic.
No, we were literally just trying to go over the answers, and then it cut off.
I'm sorry. I inadvertently hit a button that closed the room, and it wasn't intentional. I didn't mean to make it that quick, so my apologies. So much for technology. Well, that was a user error. Let's see, is everybody back? Oh gosh, it looks like you guys are back. Okay, all right. Sorry about that. I shut you out of the rooms way too fast. That wasn't intentional. I was clicking on something and hit the wrong button. Okay, so for this problem, to start it out, it's always a par value of $1,000. So that's always our future value. These are 20-year bonds, but they're semi-annual, so our N will be 40. Our payment is 7% coupon, which means we get $70 per year or $35 every 6 months. Now, the one thing, if you're using calculator or Excel, remember your payment and your future value have got to both be positive signs, and then you're going to get back a present value that's a negative sign, and that's fine. But your payment and future value have got to be the same sign. Otherwise, this will never, ever work. And our yield to maturity is, in the first problem, part A is 7%, which means our yield is 3.5% per period. So Dana, what did you get for part A at a 7% yield to maturity? What's the bond selling for? Dana, turn your mic on.
I calculated it with the wrong numbers. I forgot to divide it by 2, so I'm not sure.
You actually, you probably, what did you get?
I just X'd out, but it was like 14,000 or something.
Oh, yeah, that's not right.
Yeah.
Okay. See, Leah, did you get something?
No, I'm just redoing it right now.
Okay. Alexandra, what about you?
Yeah, I also didn't get it yet.
Okay. Tyler?
No, I'm sorry. Our our group really didn't have enough time, so
I,
I'm doing
I,
it in
I,
Excel right
I,
now.
I crunched your time. Okay, let me do this. I'm going to put you back in your groups, and what I want you to do is take the time to do problem 2. And you know what I'm going to do is I'm going to give you problems 2, 3, and 4. Okay, because I've set this one up for you to remember that your N has to be doubled, your payment is cut in half, and your yield to maturity is cut in half to get to a present value. So what I want you to do is problem 2, 3, and 4, and then take a break. But get those problems done first. Let's come on back at 12:35. That'll give you enough time to work the problems, and I'll put a good number of you in each breakout room so you have enough to work with. So do problems 2, 3, and 4, and come on back at 12:35. Finish the problems and go ahead and take a break. Any questions? Your rooms are open. I'll see you in a few minutes. Okay, Dan, for number 2, part A, if the what's the yield to maturity on a bond with a 7? What's the price of the bond if the yield to maturity is 7%? Dan L.
It's just its face value.
Perfect. Sorry, Dan Ryan. Okay, thanks.
I had heard Dan in the.
No issue. I forgot there's 2 of you guys in the class. You're exactly right. So when the par value, when the yield to maturity is the same as the coupon rate, the bond's selling at par, and so it's $1,000. And we'll show the calculation in just a second. All right, Dan L, you're up then. So if the yield to maturity is 9%, what's the price of the bond?
Sorry, I'm just trying to do it on the calculator right now.
Okay. While you're working on that one, let's see who's next in my line here. Emily, what did you get when the yield to maturity is 5%?
We got 815.98.
That was the 9% one. What'd you get for the 5% one?
Was that C?
Yeah, C.
1,251.03.
Beautiful. And Dan on the calculator, Dan L on the calculator, did you get 815.98?
Yeah.
Great. Are you lying to me?
No.
Okay, good. Hold on, let me get this thing to advance. Okay, so here's how we did the formulas. Now, this is the formula using the real bond yield formulas, but you don't need to do the full bond yield formulas. But I wrote it out so that you'd see what my inputs were going to be. If you're doing the bond yield formulas, you have to put the dates in as, you have to put the dates in as actual dates. So the settlement date was the date that the bond was issued in 2000. Maturity date is when it matures later on. The coupon rate, and then you tell it that the coupon's per year or 2, so it's a semi-annual. And everybody okay with those answers? Did you get those okay? Good. Okay. So for number 3, now we want to do we want to find the yield to maturity. And let's see. Dean, what'd you get for number 3?
I got 5.85%.
Okay, and how did you do that?
I put in the calculator, N is 26, PV is 1,050, payment 32, and then future value 1,000.
Beautiful.
And then I got that number multiplied by 2.
Beautiful. And you found the only trick in that problem was that 15-year bonds were issued 2 years ago, so there's only 13 years left in the life, so it's 26 years to go. And then exactly right, you ended up with 5.8%. 5. Ooh, did you tell me 5.8%?
I said 5.85.
And it's 5.36. So tell me again what you put in the calculator.
I put 26 is N,
and
then present value I put 1,050
as a negative number.
Yeah.
Okay, that's right.
And I put payment as 32.
That's the problem.
Yeah, I think I put the wrong payment in.
Yeah, it's 5.9%, so your payment should be $29.50.
Oh.
Switch that and see what you get then.
What did I just put? Give me a sec. I just put my calculator somewhere.
Of course. The only tricky things to remember when you're calculating a yield is to remember to put in your present value as a negative number. And I like this problem because it uses some of the nomenclature you have with bonds. So the bond is selling at 105% of par. Okay, 105% of 1,000 is 1,050. So just remember present value in negative, your future value and your payments are positive.
Sorry, I just typed it wrong again like an idiot.
No problem. Take your time.
Present value is minus.
And so, Chris D., since this bond is selling at a premium, what do we know about the yield to maturity relative to the coupon? Turn on your mic.
It's greater than?
Which is greater?
Yield to maturity would be greater than. Wait, your question was. Wait.
Okay, so the bond is selling at a premium. So
Right.
is the yield going to be greater than or less than the coupon rate?
It would be greater than the coupon rate.
No, it's actually going to be less than.
Oh.
Your coupon, you're locked in at a coupon rate that has to be above the yield. That's why people are willing to pay more for your bond, because your interest payments are greater.
Okay.
Okay. So when the bond is at a premium, the yield is below the coupon rate. Okay, Dean, how are you doing?
2.63%, and then you multiply
And then what
that
do you
by
do?
2. Multiply
Good.
that by 2.
Okay, and you get 5.36.
Yep.
Good. Everybody okay on how we got the yield on number 3? Okay, now we're going to move to number 4, which we want to find a coupon rate. And again, we've got a premium bond. And so let's see, who haven't I spoken to in a while? Rachel, what'd you get for number 4?
So we didn't come up with a number, but we put all the inputs in. I just didn't have time to solve it.
Yeah, go ahead and tell us the inputs then.
The N was 23 years. The yield to maturity was 3.65%.
Good.
The present value was 1,080.
As a negative 1,080. Okay, remember to put that in as a negative. That's probably where there was a problem. Okay, what else?
And then future value is 1,000.
Good.
And then you would solve for the payment and then divide that by 1,000. Right?
You don't need to divide that by 1,000. Let's see. Okay, so you're exactly right. So there's 11 and a half years left in the life of this bond, so that's 23 more payments. The yield to maturity is 7.3%, so we cut that in half. Future value is 1,000. Present value is a negative 1,080, and we're computing your payment, which was 41.7. You multiply it by 2, that gets you to the 83.4, and then divide it by 1,000 to get to your coupon rate. And this one, they asked for a rate of 8.34%. Good, good. You had everything other than the final calculations. Everybody good on how to do those calculations? The only tricky thing, the only thing you haven't seen before was turning it into a coupon rate, seeing that the present value is a percentage of par. But these problems are really nice and straightforward. They work beautifully on the calculator. They work really nicely just in using the standard Excel formulas we already have. I included in the slides the yield formulas if you were doing bond trading, but you don't have to use them. You can use the same formulas in Excel that we've been using. You're going to get exactly the same answers. Any questions before we move into some of the vernacular with bonds? Okay. Oh, that's just that same problem worked out. That'll be in the slides. Okay, so now, as we said, the value of the bond moves inversely to the discount rate. And that makes sense because as interest rates get larger, we're locked in at a lower interest rate. And so the value of my bond is going to decline. And there's 2 different types of risks that we have with bonds. We have price risk and we have reinvestment rate risk. And the price risk is what happens to the value of my bond as prices change. And what we find is 2 types of bonds have more price risk. Long-term bonds have more price risk than short-term bonds, and that makes sense. It's like your mortgage. You're locked into a rate for a long time. So as interest rates move, and if you're locked in at a rate of 15% and interest rates move lower and lower, that cost you're paying for that mortgage is worse than it could be. That's why people refinance their mortgages. So long-term bonds are locked in, are more impacted by price risk, and low coupon rate bonds, because if you have a very low coupon rates, the odds are the rates are going to move above your coupon, and so you're subject to more price variation as well. Now, it's exactly the opposite for reinvestment rate risk, and that makes sense. So reinvestment is that the fact that you may have to reinvest your dollars into back into the market. So short-term bonds are subject to more reinvestment rate risk because they have to be reinvested more frequently. If you got a 2-year bond, you're subject to what are the interest rates 2 years from now, and so they could have moved wildly and not necessarily in your favor. Same thing with high coupon rate bonds. High coupon rate bonds, you're locked in at a high rate. The likelihood that rates are even higher than that are not typically all that great, so you're subject to more reinvestment rate risk. And they've got a couple of good graphs that show, and it's really the volatility of the different bonds and how they make sense. But if you can't remember those concepts, you could figure it out real quickly by sitting there and doing a quick problem. So which one's got more reinvestment rate risk? Well, let me look if the life of the bond is 2 years versus if it's 15 years. Which one varies more as interest rates change? And this is the coupon rates, and shows that as the discount rates move, the high coupon bond has more risk. Okay, so if you have a bond with a 10% coupon, 15 years to maturity, and a par value of 1,000, current price is $9.28. Will the yield be more or less than 10%? So the bond's selling at a discount. So what do we know about the yield? Is it more than the 10% coupon or less? Leah?
So for discount, the yield would be more than the coupon rate.
Beautiful. The reason that's important to keep in mind is it helps you check to see if your answer makes sense. Because if you got back 5.5%, you forgot to double it, then immediately you know, well, something's not quite right. So, and Leah's exactly right. The fact that for this bond, it's selling at a discount, that means other bonds are yielding above 10%, and in fact, it's 11% for this one. There's so you can look back at it. There's the formula for the calculations. Now, if we have a bond, the 10% coupon that's selling at a premium, what do we know about its yield? More or less than 10%. Sean, more or less than 10%.
It'd be less because they could get more elsewhere.
Good. Okay. All right. Indeed. It is yet less. And remember, if you come up with 4%, remember you've got to double it to get to the yield is 8%, the annual yield. Again, I put the formulas in there. Okay, now the nice thing with bonds, you'll see when we get to our cost of capital project that we do, whereas with stock price, the book value of stock and the market value of stock are radically different. Remember, we typically carry stocks on our books at about a par value of $1. Picture if that's what you were carrying Berkshire Hathaway. I mean, the difference between the book value and the market value of Berkshire Hathaway or Apple or Amazon or any of these pretty much any company, the book value and market value are quite divergent. Bonds are a little different because while there are far more bonds outstanding than there are shares of stocks, there's far less trading in bonds. Many bonds are placement issues and they're never traded at all. They're held to maturity. So as a result, the book value and market value of bonds don't move all that much unless we're in a really risky interest rate environment. But in general, they're real close together. So if you know the price of a bond, let's say Macy's issues bonds today and they've got a 6% yield, and you look at a similar company, let's say Dillard's, let's say they're similarly risky, or even a company in different industry. Let's say you're looking at Cigna Healthcare and you determine that their bonds currently have the same rating, then if Macy's bonds are selling at 6%, you can presume that Cigna's bonds would also be selling at about 6%, and that's important for when we get to the cost of capital. Most of the time we talk about coupon bonds, but there are things called zero coupon bonds. And these are typically, we think of as treasuries. They make no interest payments. You put in a dollar amount and you get another amount back later. When our daughter was born, let's say she's 34, so it's a little while ago, but when she was born, we bought some what they called cat bonds. back then, and they were zero coupons, and the interest rates were outrageous. It was 18%. So we paid virtually nothing for these bonds that matured when she was 18, ready for college, and we got no payments in between, but you got a lump sum at the end of the 18 years. Unfortunately, you don't see deals like that these days because the rates aren't like they were back in those days. But then again, my mortgage was 16%, so interest rates have moved a little bit since then. Okay, so the entire yield is coming from the fact that you're paying a discount compared to the par initially, and these bonds can never sell for above par. That's technically true, but there are some countries now that are in negative interest rates, so it's possible they would sell for above par, but that's an unusual situation. They're just called zero coupons. And a standard one that we think about are treasury bonds. If when you were growing up, your grandparents gave you a treasury bond as a birthday present, it would say $50 on the bond or $100 on the bond. They paid a fraction of that, and you just hold it till it matures. So if we have a zero coupon bond, 15 years, semi-annual bond, and it's $1,000 par and yield to maturity is 12%, what would you expect to pay for this bond? And I want you to do this problem, and it's interesting. Even though there's no coupons throughout, you have to think about this as a semi-annual bond. So your 15 years need to stretch out to 30 because the bond, even though it's not making payments, it is calculating interest every 6 months. So your compound interest is a little greater. I'll go ahead and stick you in your rooms really quickly, just for a couple of minutes, to go ahead and calculate this problem, and then come on back in.
Sounds about right.
Okay, Emily, let's give everybody a minute to get back in here, and I'm going to call on you. So. Okay, Emily, how'd you do? What'd you get?
I don't think I got the right answer because I was trying to put it in Excel and it came out as 1,000, and that's definitely not right.
Yeah, no, that's not right. Okay, not sure tell me what your inputs were in Excel.
Well, I did for the rate, I did 6%, and then the periods I did 30, and then for the next number I did 60, but I think that might be my problem.
What did you do for 60?
For 60, because I accidentally took the the payment of like 12% and
Okay.
then divided that in half.
Yeah, but remember, this is a bond with no payments, so its payment's going to be zero. So just a future value is the only cash flow associated with this one. So Connor, what did you end up getting?
In our group, we got 411.
Tell me what you did to get 411. You're muted. Try again.
Sorry. So we doubled the year because we cut them in half. So our N was 30. We cut the interest rate in half since it's semi-annual to 6%. Our future value was our cash flow of $1,000.
Was it your cash flow or was it your future value?
Our future value. That's
Okay.
our only cash flow. So, and then our payment is zero. So as long as we hit enter correctly, it should come up.
Yeah, I don't think you hit enter correctly. That was the only thing. That was odd. Do it quickly on your calculator again and see if you got 174.11.
Okay.
Yeah, everything you said was exactly correct, but something went awry there. That's why I was wondering. Yeah, you couldn't have put it in as a payment.
Yeah, in our group, we used I just used a website and it did it annually or semi-annually, even though it was, I don't know, it was a calculation on that part, I guess.
Did it come up with the right answer?
Yeah, now when I did it the other way, it came up with 174.11. That's, I guess, what we should have.
So you used we'd have to see what the formula was in that particular website.
Mm-hmm.
Given you're not allowed to use the website on the test, it's good. I'm glad your calculator came out with the right answer. That's a good thing. Okay. Everybody good on how we got the 174.11? Let's see, I don't think I put in the calculator. So your future value is 1,000. Your N is 30. We're going to double those number of years. Your yield to maturity is 12% or 6% every 6 months. So you put in a 6%. Your payments equal zero, and you're computing a present value. And you should get that 174.11. If you're still having trouble with it, let me know, and I can pull it up on the calculator to show you the calculations. Same thing in Excel. You should just be able to do the present value calculation. Okay, let's see. Hold on. Okay, so there's a section in here with just some basic background on bonds. You should look through this really for your own edification more than anything else. You should know what the Treasury is. A municipal bond often has tax advantages. Now, the beauty with bonds is bonds are cheaper than equity because bonds are the debt holders are the first to get repaid after the attorneys in the event of bankruptcy. Plus, your interest expense is tax deductible. So the cost of bonds is significantly lower than than equity for most companies. So in addition to this lower interest rate, we also have the after-tax advantage. And typically when we talk about bonds, we talk about their after-tax interest rate. Now, corporate bonds do have the possibility of defaulting. Picture Toys R Us bonds today. They're not worth a whole lot at the moment. And so we have different agencies that rate bonds and tell you how risky they are. And for bond ratings, know that the same company can have some highly rated bonds and some lesser rated bonds, only because they have multiple issues outstanding. The earlier bonds may be tied to some of their assets, secured to some of their assets. Later bonds might not, and they may have so much debt that the company starts to get risky, which is really what happened to Toys R Us. Theirs wasn't so much a failure of retail. Theirs was a failure of investment bankers coming in and over-levering the company. And those later bonds are going to get paid very little as the company goes through bankruptcy. There are bond markets. In general, they're OTC markets, so they're over-the-counter. Most bonds are private placements and really don't trade. So even though there's a lot of bonds out there, there's not a whole lot of trading volume. Pricing trading, what did I mean by that? Well, we talked earlier about the fact that the book value and market value of bonds are really pretty typically very similar. Now, one of the things that you may have noticed when we were doing capital budgeting, we're figuring out those cash flows, we didn't really adjust, we talked about it briefly, but we didn't really adjust the cash flows for inflation. We adjusted it for changes in demand from our customers and maybe price increases, but most of those price increases are driven by what the market can bear rather than interest. And the reason we don't pay attention to interest in the cash flows is because we do with bonds. So we have two different kinds of interest. The real rate of interest is our purchasing power. The nominal is the quoted rate. But what we most pay attention to is the real rate of interest. What can you buy with this interest payment? Because if we're earning 10% and we're in Venezuela and the inflation rate is 200%, we're losing ground as we're holding this investment. So a good approximation, it's pretty close, is the real rate of interest is the nominal rate plus the inflation rate. So if you're locked in at 10% and inflation is running at 2%, then you can see that you're that in essence. So if you're earning 10% and the inflation rate is about 2%, then really the real rate is only about 8%. That you're earning is really only about 8%. Okay, and what affects the return on bonds? Well, certainly the riskiness of the company, so the bond ratings. That's why when most companies go to purchase another firm or they're looking to expand, the first thing they do before they get too far down the road is they go to the bond rating agencies and say, look, we need to borrow this amount of money. What impact will it have on our bond ratings? And if it will cause the bond ratings to fall, for many companies, the project is done right there. They won't go forward because that bond rating is really important. In fact, there's covenants that the bonds will maintain a certain rating for many companies. We want to look and see if the bonds are taxable. So for some bonds, especially municipalities, they often are tax-free. We want to look and see, for some companies, liquidity is important. The ability to sell bonds is important. Most bonds are not traded, but if there is a market for the bond, some bonds have a premium as a result, or have a higher price as a result. And then anything else that affects the cash flows to the bondholders. The only other thing, these are some basic concept questions that if you know the answers to these questions at the end of this chapter, they'll help you in terms of being able to answer the kinds of questions I asked. So this quick quiz, the questions are pretty decent. Any questions about Chapter 8? It should be a pretty easy chapter for you. There's a little bit of background on bonds, which you probably had in your 320 class previously, and then just the calculations. And really problems 2, 3, and 4 is the sum total of anything that we're going to calculate with bonds. Any questions? Okay, next week we're going to do Chapter 9, which is the equities chapter. We're also going to talk about Euroland. So it's not a bad idea to go ahead and buy the Euroland case and take a look at it. I'm going to, after next week's class, I'm going to give you your assignment and additional information about Euroland. So not a bad idea to have looked at it. I will be in Selinger 003 next week at 11 o'clock, but I'll also be on Zoom. So you have your choice whether or not you want to come to Selinger or you want to participate virtually. Either way is fine with me. And that's it. Have a good rest of the snow day. Enjoy the snow. Be careful if you're driving around, and have a good week. I'll see you next Wednesday. Bye, guys.